Good morning. Time for another What's Up with the Market. Doing a market status update. Haven't done one of these for a while because beginning of May I did a secular bull market update. So that kind of replaced this one. So we're about probably about 7 or 8 weeks since we did one of these last. So let's get into it. The question, if you like, a theme for this session is sell in May, go away? ? We'll get into that in a moment. Just a reminder that everything I cover here is generic technical analysis, and there is no there's no mechanical in this. This is just generic. There's trend lines. There are support and resistance zones. There's Fibonacci, and there are sentiment indicators. There are breadth of market indicators, and there's raw price action analysis as well. And none of this is used in SPA3 Investor or SPA3 Trader. And nor do I use any of this to make my decisions, my buy and sell decisions for the public portfolios or even in my own personal portfolios either. I'm 100% mechanical and have been for a long time. Right, and I precisely follow the systems. So everything we cover here today is of generic investment advice nature. There's no personal or direct financial advice. Before I get into it, I just want to remind you that these analyses that I cover, you can download these, you can import them into your Beyond Charts. You go to the analysis manager and you import. That's the import arrow over there, and you select SWS analyses, and you will get all of this analysis that I show you today, plus all of my other analysis that I do for stocks. And I've recently gone through the entire SPA3 Investor ASX universe and updated my analyses on those. And I typically do it when they come into the portfolio. I do it updated, but I just went and had a look at a few others that haven't been in a portfolio for a while because they're in downtrends, and just updated those as well. So you can import those into your instance of Beyond Charts. Okay, let's get over into Beyond Charts and start our analysis where we always do on the Dow Jones, and that's the kind of analysis that you'll see for the charts as well. So we do have an open trade on the Dow Jones. Why? Because there's a SPA3 Investor entry signal there. There was an exit settle up there. Kind of missed all of the Trump shenanigans with the tariffs in early April, and it's heading up towards there's the new all-time high. So certainly in an uptrend, the early April, around about the 7th or 8th of April thereabouts, are these bars here, and now the market's bounced. Just looking at here, the Dow Jones is underperforming the S&P 500. And that's typically what happens when there's a risk-on environment. That means the broader stocks in the S&P 500 are coming into play into that index and pushing it up higher than just the 30 constituents of the Dow Jones. So that is a risk-on, that underperformance. This is a relative strength line. It's a ratio comparing the S&P 500 to the Dow Jones. So this is certainly in a short-term uptrend as well, and according to SPA3 Investor, a medium-term uptrend. So let's have a look at the S&P 500. Similar, there's the all-time high. I haven't put the black resistance zone in there, but you could draw those in yourselves. But it's certainly got above this support resistance zone over here. Is an open trade as well. Volatility has died right off. That's an ATR. That's a monthly ATR VE. That's price. So that's a percentage number that's represented there. So volatility is down to 1.534. So this is in an uptrend. So far, to answer that question, sell in May and go away, certainly not an indication of that at the moment, because we have longer term trends over here. There was a primary bear market there for a period of time, and now we are certainly in a primary bull market. And if we go to my swing chart, you'll see that we are in a down, that there's a downswing there. We need 3 up days, so higher highs, higher lows on the way up, taken out that high over there. now heading up to this high over here. And I would this is what I would do to put in the upper support resistance right up at that high over there, and that is where the S&P 500 is headed now. And you can solve that. You can save that by Control S, and that will say overwrite the existing analysis that you have. So it's this is certainly not a sell and may go away situation at the moment. Looking at whoops, I should just go here. No. Just going to turn that off. We do there's no breadth of market indication here. There's no what we're looking for here. Divergences, no divergences in the cumulative new high, new low, and nor is there in the cumulative advanced decline line. So we got these going in the same direction. So there's more stocks now rising than falling, and the index is going in the same direction. So that's a positive note. We also don't have any divergence looking at the number of stocks in the S&P 500 that are above their 150-day moving average. And you can see this got to a oversold zone. Sorry to zoom out over there a bit. So this is an oversold zone for the number of stocks that are above. So they were less than 15% above their 150-day moving average. And that typically signals an oversold zone. And you can see it doesn't get down there that often. That goes all the way back to 2018, 1, 2, 3, 4, 5 occasions where it's got down there. And that certainly signaled a V bottom. There's no guarantee that it'll always be a V bottom when you get down there. Here's one where there was a bit of a rise and then came back down to below 15%. So that was in 2002 bear market. This is 2019 and 2000. There's twice there in 2019 that occurred. So that's that is certainly from a analysis perspective. This is a risk. This is also indicating a risk on. We ran about half the number of stocks that are above their 150-day moving average. You can read that one of two ways. The way from a bullish case is that there's still more stocks to get above their 150-day moving average, which means there's still some more upside. And from a bearish case is to say, hey, even with this strong price action, there still hasn't been half the stocks still haven't got above their 150-day moving average, bearing in mind that we very seldom get to 100% or never get to 100%, but above that 85% line is where there is an overbought zone and that's just generic. There's no massive science behind that. That's eyeball mark 2 that's telling me that. So the risk on from that perspective. Right, looking at the US dollar, I've put a different chart up here to what we normally look at. There is the US dollar long-term uptrend here, probably started back to here in 2006. And the case that I've been making for some time, certainly over the last few years, is that there's an inverse relationship between the US dollar and equities. So when the US dollar rises, equities tend to fall and vice versa. But there's a situation that can happen whereby in this situation here, or that the US dollar is falling, if you go back in history, you'll find that in a secular bear market, they tend to spend more time going in the same direction. So here's an instance. Here, the US dollar was falling from 2002 to 2006. And the market did rise during that period of time. But there were periods here. There were more periods where they were going in the same direction. So there's talk around the world at the moment that Trump is trying to weaken the US dollar, and therefore that's going to bring stocks down. Now, and that is what I've been saying for you, and certainly the analysis shows that certainly over the last 10 or 15 years, they've had an inverse relationship at periods of time. But that said, the secular bull market started around about here. That's around about April of 2013, around about there. And there has been a long-term uptrend while the market has been in a secular bull market. So there is a case in the long term that they go in the same direction. So and I guess what the analysis is that if we have the US dollar going into a long-term decline, that could pull equities down. But you would have seen the analysis that I've done over here is that there's a lot of They're not coming up. Must be this one here. Sorry, I've got all the data on here. Is that this analysis here shows that they go in opposite directions. So for some time, you see rising US dollar, falling market, rising market, falling US dollar. That inverse relationship is certainly in recent years has been an inverse relationship, but in the big picture is that if Trump does pull down the US dollar through all the things that he's doing, that is going to pull the S&P 500 down. We remain to be seen because there's conflicting evidence there from a technical perspective. So there's nothing guaranteed in this game. Right, let's just looking at sentiment. A sentiment indicator that is growth versus value. And this here is the growth index. And what we've done here is we've put a ratio, a relative strength ratio that's dividing one by the other to see which one is strong at any given time. And I've then put a moving average on that relative strength line, and then put a smooth index rate of change on that moving average. And that gives us a bit of a smoother read of what's going on in the market. So here, when that gets over there, we give a sell signal, and there it certainly showed that value was outperforming growth, and that gave an exit signal. Now, this is not perfect; it's not a perfect timing indicator, but certainly what we're looking for here is longer term sentiment that plays out between growth and value, and we now do have a risk on market. So far, the analysis is showing that because why we got that because growth is outperforming value at the moment. Therefore, we've got this going up. There's the relative strength line going up. So when growth is outperforming value, that's typically a sign of risk on from a sentiment perspective. Another one is looking at consumer discretionary versus consumer staple, and a similar thing has happened here. There was the relationship here showed on the relative strength line with the smooth index rate of change ahead. You could even have put there's another way of doing this analysis is you can look at when the relative strength line crosses below its moving average, and that there would have given you a more timely exit to get out, and over here a little bit more timely if you wanted to use it as a confirming sentiment indicator, if you like. You could go directly to the relative strength line and the smooth and that moving average that I've got on there as well. So that's using the value line. But what I've done, just to give a little bit, I've gone back and done a bit of analysis and try to smooth it here to take out the whipsaws that would happen in a market like this, and that smoothing just gets a bit more smoother and easier to read. So what do we have here? The relationship between discretionary and staples is showing that we do have a risk on, is just happened over there as well. Right, and now going to the put call ratio on equity options, and looking at the volume between the relationship between puts and calls, i.e. calls is bullish and puts, and this is buyers, this is not sellers, buying of calls and puts. And I've also got a different chart here as well, and this is showing that the risk on has been on this since all the way back here in August of 2024. Why? Because this declining is showing that there are more calls than puts. The one that I normally show you is this one, and that is also given a risk on over here. And there you can see the lower lows occurring over there. So we do have a risk on indication from the number from the put call ratio as well. Right, let's go to interest rates. This is the 10-year Treasury note, and this is showing that the relative strength is that there is a fall. This is also a risk on. So this smooth indicator on that relative strength is again also showing the relationship between equities and bonds, yields, bond yields, is that we've got another risk on situation as well. And if you look at the actual bond price itself, this is 20 years. We've got a rising market, falling bonds, which is not typically what you would see. These should go in the same direction, but my analysis here points out how often they go in opposite directions, and that's why I've made the point that, because obviously bonds goes in the opposite direction to yields, is that typically when yields go up, markets are supposed to fall, but the short-term relationship is not as clear, so they're going in opposite directions there. Looking at the VIX index, this dropped on today's session in the US, but it's staying within this band over here. That was during the Trump tariff, got right up into the extreme zone. We had those sharp falls where the market fell 10.5% in 2 days in the S&P 500, and you can see pushed up volatility. But that's now back into a healthy zone as well. Right, looking at the NASDAQ Composite still has not given an entry signal yet. The high volatility of this index compared to the S&P 500 has kept the entry signal a long way away. However, we've just starting to see the NASDAQ Composite outperforming the S&P 500 here. The right crossed above its moving average. I've got a 55-day moving average on this relative strength. And the smooth and the Ciroc indicator, which is an indicator of the moving average, has also started rising, sharp rise up there. So waiting for an entry signal on the NASDAQ Composite, but it is starting to outperform the S&P 500, which is a risk on. The NASDAQ 100 gave this entry signal a little while ago. It has given an entry signal, so it has moved up, showing that larger cap NASDAQ stocks are doing a little bit better than the smaller cap, because the NASDAQ Composite is all 2,000 plus stocks in the NASDAQ. That's the NASDAQ Composite. So this is also a risk-on situation. NASDAQ 100 outperforming the S&P 500. Right. This is the cumulative new high, new low of NASDAQ 100 stocks. And there's no divergence there at this stage. They were going in the same direction down there. There was a little bit of divergence to maybe signal this, but not a huge divergence. But it doesn't always follow through when you do have that divergence. And nothing to see on the NASDAQ 100 cumulative advanced decline line either, going in the same direction. Looking at the number of stocks in the NASDAQ 100 above their 150-day moving average, also got into this oversold zone. How often? Let's just have a look at the last few years. Doesn't get down there that often. It's going back all the way to 2018, and we had the V bottom just with that getting down into the oversold zone as well. A bit more than half of the NASDAQ 100 above their 150-day moving average. Right, looking at the SOX, the semiconductor sector. This is not a major index. It's a sector of the NASDAQ. The NASDAQ 100, and you can see this is underperforming the NASDAQ 100. And to have a truly risk-on environment, you'd want the technology or the semiconductor sector to be outperforming its parent, the NASDAQ 100, which is not happening at the moment. It's been a bit squiggly on the way down here, but that trend line is showing it's definitely down. A little bit of outperformance here, but not enough to get the Ciroc to rise above 10 like it did over there to get a strong risk on environment. So if we are going to get a bit of a raging bull market, if you like, we need this index to come to the party. Right, looking at the all ordinaries, there's the downtrend, cut out of the channel, rose above the channel there, is shown a little bit of this period over here showed outperformance of the S&P 500, which typically meaning that the All Ords goes down by less than the S&P 500 when there's big volatility on the market. So, and now then that little bit of underperformance there showing that the S&P 500 is starting to outperform the All Ordinaries as well. And there was an entry signal, if you like, a low market risk for SPA3 trader back on the 17th of April. So that's just over about 5 weeks ago. And look at these narrow bands over here of green days, lots of green bars there. So this is also an indication of that we've got risk on. It's so far there's no sell in May and go away at this stage. And while that could change in a flash, because sell in May go away typically lasts through to the end of October. So the summer months is the theory, seasonality, and but it's not every year. So people have to keep watching the charts to find out and follow their systems to. Oh, sorry, you should just have a chat about the Aussie battler. It's still in this long-term downtrend, but is in a short-term uptrend. and has risen above 65 cents of recent times. He has a very messy chart, not much of a strong trend there, but did give an entry signal on of the Australian dollar v the US dollar. So a little bit of upside there. Looking at Japan, there's the all-time high back from 1989. Look at this, really struggling here. Big arm wrestle going on between buyers and sellers around this long-term 1989, many, many years ago. And there is a confusion at this point, indecision at this point. There are a lot of economic factors showing that Japan is not doing that well economically. But we know that the economy and the stock market aren't necessarily aligned with each other from a timing perspective, but hasn't given an entry signal there yet. And certainly in a short-term uptrend, but not this long-term uptrend. You can see I've got drawn over here. Still continues, but still, it's got to break above that all-time high and then see what happens from there. Right, the DAX is also in a long-term uptrend. It's given a new entry signal and made a new all-time high. So DAX is going very strongly despite the weak economy in Germany. And as I said, the economy and the market are not always, very seldom aligned together. Certainly from a timing perspective, one leads the other, and typically the market leads the economy. Now there's a very strong V bottom. This here was a previous all-time high, bounced off that, a 78.6% retracement, even though you probably say that the 50 to 61.8% retracement. So big, strong V bottom over there, and off we've gone again to new all-time highs. So probably a time to pause there and just talk about variables in the market. The reason for this fall is the Trump tariffs, but how often are Trump tariffs a variable in the market? Well, it's unique. It's the first time this Trump tariffs have ever affected the market. Now, sure, tariffs have, and other people have imposed them, but the prediction of those, even though people were aware of them, there's still a whole bunch of people. Some believed, and each person, each trader, each investor, each investing company is a variable in the market to whatever the entity is, whether it's a single human being or a group of human beings, they are a variable that come to a conclusion as whether to buy or sell. And every single one is a variable who have opposing ideas. There would have been people predicting that the Trump tariffs are going to do this, but they didn't predict that he was actually going to put the tariffs on. And they said, if he does this. So there are so many unknowns. And the point I want to make is that there are always going to be variables, and we're never that are going to do this sort of thing to the market, but we're never going to know in advance which variable is going to do it and when. And to try and play that fool's game of predicting based on what you think certain variables are going to do is just a folly. It's just you'd spend your whole life doing it and still get it wrong, the majority of the time. So that is why we go to not the language of human beings and noise, we go to the language of market, which is the collective. It's this Mr. Market is this collective of human beings. The net, either positive or negative, that comes out, plays out in the price action, and we listen to the language of the market. We listen to the language of price action. We read it and we listen to it. And then the more objective we are about putting our decision-making into the movement of price, the easier this game becomes. And the less objective we are, the more subjective, and the more we are influenced by outside commentary, which are people words, human words, the more difficult this game becomes. It just becomes impossible to do, because you take one variable of what somebody said, a commentator says, and they get it right with their logic that time, and the next time you go and put some weight into, they say whatever they say the next time, and they're wrong, because they can't be 100% right. So the only thing that we can actually believe and trust in is price action. And these variables, so often, the ones that we hear, are so often that the commentary, the innuendo, the opinions are just more often wrong than right, and they aren't consistently, the noise that comes out isn't consistent in its ability to be able to predict. So let's get rid of prediction and just react to what the market tells us. Listen to what it's saying and then react. Don't try and preempt what they're going to say. Be a listener, be a good listener, be a good reader, but don't try and preempt and predict what the market's going to say to you. Just follow the price action, because there are too many variables for us to be able to listen to and read to be able to use as a predictive tool. And you will see lots of people say you can predict. That's probability, but it's about listening. So the FTSE 100 is also at all-time, close to all-time highs. There was its all-time high up there where that trend line stopped, and it's getting very close to it as well. The highly underperforming, there we can see. So all this time going back here to 1994, that's a relative strength line relative to the S&P 500. Look at the underperformance of the FTSE 100 over all of that time. Okay, let's go to the BASA, also sitting near all-time highs. That was the previous resistance line at the all-time high. I've kept it in there just to show, and sure enough, there is, did that make a new all-time high? Probably a little bit below that there, which was 139.6, so it's just a little bit below that all-time, oh, sorry, there's the all-time high there, 140.109. So it's in an uptrend. There's a medium-term uptrend and sitting near all-time highs, developed markets. So FTSE, DAX, and BASA near all-time highs, and we'll see another one in a moment as well. Certainly not the Chinese markets. They're a long way from the all-time highs, but starting to get some outperformance here against the S&P 500. I should turn that off because that's... so you can see maintaining, but their outperformance of the S&P 500, and the Shanghai All Share Index also starting to show outperformance. This period over here, look, there's an up. I should have put a trend line in there. We can do that, and there we can see that outperformance of the S&P 500. So Chinese market starting to do a little bit better relatively as well. The Hang Seng, I've got the Hang Seng in here too. I must have put it in. Not outperforming yet. Look at that long-term sideways going all the way back to 2007. So it hasn't made a new all-time high yet. So we think of where the US markets are from that, because that there was the secular bear market all that time, and the US markets have shot out the top here. Hang Seng is still down here. Look at that underperformance of the S&P 500. It used to be a darling during that period there, but now we've had some 20 years of sideways, nearly 20 years of sideways movement. And South African market, another developing market, also at all-time highs. So I've turned that into a blue, and there it is. So outperformance of the S&P 500 and an all-time high, similar to the BASA. So sell in May and go away at this stage has not come true. We're almost at the end of May. We'll have to see what happens into June, July, when we get into, or certainly July when we get into the US holiday season, to see what happens. But you know, when the markets are running and they're going up, investors tend to stick around. Okay, let's just have a quick look at commodities. CRB index going sideways. Been some time it's been going sideways. Underperformance of equities. And then the next is gold. So gold having a little bit of a retracement. I do have a Fibonacci on there. There's the 38.2% retracement. Lower highs, lower lows at the moment. Will this break out below this channel? And we've seen outperformance of equities there. That's the S&P 500 that it's being compared against, and underperformance since when is that? Since 21st of April, about a month. So will gold take a breather or not? We have to wait and see, but it's certainly in a sort of a medium-term downtrend at the moment. And silver hasn't quite caught up yet. This is relative strength to gold, so you can see it's falling. You do want a confirmation of the gold bull market, if you like. And when gold trends, it trends very long term, is that you do want to see silver confirm it. And we got copper at near all-time highs as well. There's the all-time high. It's snuck above it a few times, found resistance there, fallen back into the range. Underperformance of equities when copper goes it does outperform equities. So this here is, sorry, that's against gold. And so copper does outperform gold, and it does it, when in a time when in the secular bear markets as well. So we keep an eye on copper for a number of reasons. The relationship to gold gives us an indication of potentially where we are in terms of the secular bull bear market, but also for small cap stocks as well. They've called it the bellwether of small caps and that, but it's whilst it's doing well, the small caps are not doing as well as what they should. So underperforming gold. Gold's rising, and we've got oil in a longish term downtrend, or it's not that long. It's not 2024, so that's going back to just over a year, but in a downtrend and falling. Where's the next support? And that plays big into inflation. It's sorry, I should also put that. It's found it's gone all the way down to its support. There we are. That was my question. So it's there. It's around about there. So it's gone down to support level. Will it bounce off it? We'll have to wait and see. Onto crypto. Bitcoin is playing around near all-time highs. I have put this, so this upper part of this line should be the highest close along here. And there is a close above. We had 1, 2, 3, 4, 5 bars above into new territory. Using the SIROC 26.9, it gave an entry signal here down at what is that, about 78, so about 83 was that rise over there, that close, and could potentially have gotten over here at around 83. So that's been a decent trend. It's put on some 25% in that period. And we still haven't had an exit signal here. So that's a shortish to medium term signal that we can use on the SIROC. So we have to wait and see whether this Bitcoin comes back into the range, or at this previous resistance levels finds support and then bounces off and trends. When it does trend, it trends. If it breaks out and goes above, we're going to see something like this, 70 to 110,000. That was 40,000 to put on over there. So let's keep an eye on that. Ethereum has been hopelessly underperforming, and Bitcoin, that is. And it's, sorry, I just wanted to show, there's the all-time high of Ethereum up there, and it's nowhere near its all-time high, but did give an entry signal all the way back down here, just using the SIROC 26.9. Onto uranium. The ETF has and some of the ETFs that follow uranium have started rising. You can see that here. This is relative to the uranium price relative to the uranium ETF. This blue line declining is showing that the uranium ETF is outperforming uranium, and it's just trying to break out of this channel here. Hasn't quite done on the uranium price yet, but there's some movers in the uranium ETFs. Okay, and now iron ore found support at this 90 to 95 level, and it's really has become a strong support resistance level. If it falls below there, you'd want to see a V bottom pretty quickly, like happened over here, but it's that was still resistance happening over there. Now it's become support. So from an Australian perspective, iron ore plays a big part in money coming into the country. So you do want to see that price rise, and obviously there's the iron ore stocks as well. Thermal coal, despite there being support and this channel over here, we said there was indecision and it was bouncing between these two in that channel, that sideways moving market. It did support broke at this level over here and has now fallen down to around about just below $100. So will support hold here, or will it fall lower is the question. Okay, one more I just want to go to is platinum. Let's just keep an eye on platinum here. Now, platinum typically follows gold and can be seen as a confirmation of the gold trend, as does silver. Now, what we have here is a number of ETFs. There's 2 ETFs I put on here. There's the PPLT, which trades in the US market, and there's ETP PMT, which is the trades in the Australian market. And the orange is the Australian market platinum ETF, and it obviously has a bit of currency in there as well. Now, that is the platinum price. This here is strong resistance at about 1,080 thereabouts, and it hasn't got above there. One time it did get above, short-lived, and came back down into the range. So what we're looking at here, there's the ETF, the ETP PMT ETF. That is the platinum price, and this here is the PPLT platinum price. So it's risen quite sharply in the short term to resistance. It needs to break through this resistance. If it does, it's an opportunity which is really a gold play. It's a delayed gold play, if you like. And if gold continues strongly, we might, and that's the way the people have missed the initial gold leg, is to keep an eye on silver and platinum and see where they go. And there are opportunities in both of those to be able to trade those two commodities. Okay, I'm going to finish up there. If there aren't any questions, I'll just go back to here and the SPX and just make the point that that sell in May and go away is not in yet. It's certainly don't sell yet, and wait for those exit signals. But it certainly is a market to be in at the moment. We are fully invested right across the board, except that's not true in the US public portfolio. We're looking for a position still, and in the leveraged, and I think also in the learn to trade properly portfolios as well. You're still looking for a position in the US market. Haven't seen the signals for today yet. There may be one. So I'll finish up there, and we'll be back in a couple of weeks' time with looking at the portfolios, the public portfolios, and the learn to trade properly study group portfolios as well. But in the meanwhile, we've got this market that's given us the opportunity to go into drawdown and to come out of drawdown. The portfolios are very close to all-time highs to complete that first level of drawdown. So I'll leave it there. Thank you for your time. And as always, I wish you consistent and objective and peaceful active investing and trading.